All right, today we're going to break down an ETF that's doing something most people think is, well, basically impossible. It's beating the S&P 500. So yeah, let's get right into it.
You've heard this a million times, right? It's repeated like gospel in the investing world. And honestly, for a lot of people, it's pretty solid advice. I mean, it's cheap, it's diversified, and historically, it's been a winner.
But what if you want a little more? What if you're looking for that nice, steady, growing stream of dividends, but you also want a fund that has actually managed to beat the S&P 500?
And that right there is the big problem we're talking about today. The hunt for an investment that gives you both returns that beat the market and that reliable, growing income. It's a really tough thing to find.
This is where the Capital Group Dividend Value ETF, ticker CGDV, steps into the ring. It's been quietly building a reputation for doing something very few dividend funds can ever claim, outperforming the very benchmark most investors see as unbeatable.
So, what is it about CGDV that makes it so different? Let's peel back the layers on this fund and the absolute powerhouse firm that's behind it.
Okay, so first things first, CGDV comes from Capital Group. Now, while they might be kind of new to the ETF game, these guys are absolute titans in the investing world. We're talking about a company that's been managing money for almost a century. This is not some startup. It's a massive institution with one of the most experienced research teams on the entire planet.
Now, what's really cool about this fund is its whole philosophy. You could almost call it the anti-yield trap ETF. See, it's not about just blindly chasing the highest dividend yield out there, because that can often lead you straight to struggling companies. Instead, it's all about the quality and the durability of the business behind that dividend check.
And this philosophy really boils down to three simple but super powerful principles. First, the dividends have to come from strong, healthy businesses, no financial tricks. Second, the growth of that dividend is way more important than what the starting yield is. And third, it's looking for value, but it's obsessed with avoiding what we call value traps. You know, those dying companies that look cheap for a very good and usually very bad reason.
So how do they actually pull this off? Well, this isn't a passive fund that just copies an index. Nope, CGDB is actively managed. And that is the secret sauce to its whole approach.
The strategy really sits on four main pillars. They look for durable companies that have strong competitive advantages. They put a huge emphasis on businesses that can consistently grow their dividends over time. They hunt for these high-quality companies that the market just hasn't fully appreciated yet. And they use this unique multi-manager system, which helps diversify the decision-making and cut down on risk.
You know, when we say durability, what we're really talking about is something called an economic moat. Just think of it like an actual moat around a castle. It's a sustainable competitive advantage, like a super powerful brand or a unique piece of technology, that protects the company's profits from all its rivals.
And on the other side of that coin, their active management style is designed to help them avoid those value traps. This is a classic investor mistake, right? A stock looks incredibly cheap on paper, but it's cheap because the business itself is fundamentally broken. The managers at CGDV are trying to sidestep those landmines completely.
All right, so the strategy sounds pretty smart, but does it actually work? Let's get to the good stuff. Let's look at the numbers and see how CGDV has really performed.
A lot of people compare it to SCHD, which is often called the gold standard for dividend investors. And you can see the key differences right here. While they both focus on quality, CGDV's active management and its slightly higher exposure to tech have really given it a performance edge since it launched.
And here it is. This is the big one. Since it launched in 2022, CGDV has delivered a higher total return than the S&P 500 itself. I mean, let that sink in. Beating the broader market is a huge deal for any fund, but it's especially rare for one that's focused on dividends.
So what's actually driving this performance? Well, the fund's sector breakdown gives us a pretty good clue. It's really built for stability. You see a lot of weight in these defensive sectors like financials, healthcare, and industrials, which tend to hold up pretty well no matter what the economy is doing.
And if you look under the hood, the portfolio is anchored by these massive, mega-cap blue-chip companies. We're talking about household names that absolutely dominate their industries and have these long histories of raising their dividends like clockwork.
Then here's what really makes CGDV stand out. Unlike so many traditional value funds, this one is not afraid of tech. It holds these high-quality, cash-rich tech giants that also happen to pay and grow their dividends. This is just proof that value and tech don't have to be mutually exclusive.
Okay, so we've seen what it is, how it works, and how it's performed. Now we get to the most important question of all.
Does this thing actually fit into your investment strategy?
Let's break it all down. CGDV seems perfect for investors who are looking for better risk-adjusted returns than you'd get from the S&P 500, and for anyone focused on long-term dividend growth. But you have to be aware of the risks. Active management is not a magic bullet. It can underperform. The fund might lag a bit if we get another crazy speculative tech rally. And because it's concentrated in about 50 stocks, each one of those holdings really carries a lot of weight. When you boil it all down, the core idea here is this. CGDV is really designed to be a smarter, more stable version of the S&P 500. It's blending quality, value, and dividend growth, all with this high-conviction active management on top.
So, I guess that leaves us with one final question to think about. In a market that's so often driven by hype and trends, could a disciplined, smarter dividend strategy actually be the real key to long-term outperformance? Well, based on the evidence we've seen here, it's a pretty powerful argument.